Let's look at how we can analyze target profit now. Here's my target profit of 35,000 that I entered as a hard number in my input sheet. And what I want to do is go grab my total fixed cost off the input sheet. So I'll go get that. There it is. Hit enter. And then I want to grab my contribution margin per unit off of the input sheet. Remember that $4.04 that we calculated? Let's go get that. There it is. Now, I'm going to add my fixed cost to my target operating income, and then I'm going to divide that quantity by my contribution margin per unit, that 404. And here's what we get: 14,501 units to earn $35,000 in net operating income. So I'm going to calculate that in dollars now, and I'll simply multiply my 14,501 in units times my $22 sales price. So I'm going to need $319,014 in sales revenue to earn $35,000 in target profit. Let's prove it. We'll plug all this stuff into our contribution format income statement. So direct materials, I'm going to multiply my 14,501 times, go into my input sheet and grab that $8.80 for direct materials, and that updates. Let's do direct labor. Again, I'm going to multiply the 14,501 times my direct labor costs per unit. Do the same thing with overhead. And then distribution. Now notice I'm using the 14,501 in the projection. I used the 6,500 units that I was projecting. Okay, that's all my variable costs. Let's grab a total. I'll go up and grab my auto sum. So $260,400 in total variable cost. Calculate contribution margin. Take sales minus total variable cost, and that gives us $58,614 in contribution margin. So let's go grab our fixed costs now. Grab overhead. And I'm just going to take a shortcut here and copy this formula down because I have overhead, distribution, and administration listed the same way I do on my input sheet. Grab the auto sum again. And calculate our operating income. We'll take contribution margin and subtract our fixed costs. And we proved it. We've got $35,000 in operating income if we sell 14,501. Notice the formula that we used to calculate the 14,501 units total fixed cost plus target operating income divided by contribution margin per unit. Okay, now let's take a look at break-even point analysis. I'm going to grab that $4.04 in contribution margin per unit off of the input sheet and total fixed cost off the input sheet as well. And this calculation is a little simpler. All I have to do is divide total fixed cost by contribution margin per unit, and I get about 58.42 in units required to break even. So let's calculate that in dollars. So I'm going to take the 5841.92 and multiply it by that $22 sales price that I have in my input sheet. Okay, so I need 128,522 in revenues to break even. So let's prove it. I'll copy that over to my contribution format income statement. And we're going to go through this process again of updating our direct materials at the level of 5841 units sold. So I'm going to multiply that by that 880 in direct materials. Do the same thing, multiply the 5841 times my direct labor costs per unit. Overhead, same program, 5841 times that overhead that we calculated way back when. And finally, distribution. There it is. And I calculated the auto sum on this one just to save a little bit of time. So there's my total variable cost. I'll take my sales revenue minus the 104,908 in total variable cost, and I get a contribution margin of 23,614. So let's calculate our fixed cost. We'll go in and grab that fixed overhead again, and I'm going to copy that just like I did with target profit analysis. Paste it. And look, operating income is 0 at our 5841 level of units sold. And our formula, total fixed cost plus 0, which is operating income at break even, divided by contribution margin.